Zoom recording. I got it. All right. Hi, everyone. Just letting you guys know this meeting is being recorded. So this afternoon, thank you so much for joining us in this networking event. And we have today 7 Foot Finance owner is going to be speaking for us. And thank you so much, Seth, for joining today.
Absolutely. Thanks for having me.
So now I need to. Okay. I didn't go. Okay. Are you guys need to stop sharing? Okay. Yes. Okay. Well, Seth Sundberg is the principal at 7 Foot Finance and a former NBA player. 7 foot. He goes by 7 foot because that's how tall he is. And of course, that's why he was an NBA player. I'm sure there was other reason beside it, but that was one of his
definitely helps.
Biggest, growing up. So he played in Northern California and he attended the University of Hawaii and was team captain of the WAC champion. He will have to explain that because I don't know what WAC is. Sure. Team and graduated with a BS in economics from the university. He went on to play professionally for 7 years in the NBA and Europe. After purchasing his first properties in 2003, Seth transitioned his love and skills from basketball into the real estate arena, becoming the branch manager of a national mortgage company. He quickly grew this branch of 49 national branches to become the 4th highest grossing branch in the nation, funding over $1 billion of real estate loans annually. He shared his enthusiasm, drive, and winning spirit with his clients and employees while personally managing 22 high-performing real estate assets across the nation. Seth now uses his skills, talents, and 17 years of experience with 7 Foot Finance, a multi-family investment and financing company dedicated to acquiring assets in emerging markets nationally with the goal of improving the life of its property tenants while generating higher than average return for his investors. And now I will let Seth speak and introduce himself and his company.
Cool, thanks, Suze. Appreciate that. I realize that's probably a long bio. I'll probably have to shorten some of that, but thanks for that introduction. It's great to be here. It's great to talk to everybody. I'm excited about the topics that we're going to cover today too. I think we're going to break it down into 2 sections today, right? Really focusing on kind of how to identify a market, and then dig into some of the due diligence when you actually identify a property. So both things I'm very excited about. One of the things that I'd like to start with is, people ask me a lot, kind of how do I, especially people that are kind of getting into the apartment acquisition space, right? Maybe they have some single family background or not really a real estate background at all, but how do you get started? How do you really identify and kind of start digging into what market I should be in, right? And what's next? And sometimes there's a lot of pressure there and all that. And I want to start with a video from one of the arguably greatest investors of all times, Warren Buffett, on how he identifies how he's going to look at a business. And we'll use that to transition into how we can start kind of narrowing down and focusing on the market that you guys want to be in. And I'll give you a couple examples of how I do it. But if you could play that, share the screen and play that video, that'd be great.
Yes, I'm looking for it. It looked like I lost it. I mean, I'm looking at your website right now.
Refresh the screen and it'll pop up.
Refresh it? Okay.
Yeah.
That's what I thought. Okay, it's coming in. Hold on. Let me share my screen.
To learn is how to value. The most important thing to learn is how to value a business. It's also the toughest to explain. You know, I look for certain things that allows you to narrow it down. So if I'm a basketball coach and I walk around the campus here and I see somebody 7 feet tall, I'm interested. Now, he may not be coordinated. We may not be able to keep him in school, but he's still the right guy to be looking at. You know, I mean, we can work with this guy. So I am interested in 7-footers, maybe 6'10". And if I see some guy that's 5'3" and he comes up to me and he's dribbling away and he's telling me, doing fancy moves, and he says, "Coach, I'm your guy." I say, "Yeah, but you get in there against these 7-footers, I'm not sure he'll be dribbling exactly the same way. I'm going to skip it. I'm not interested." So I am looking for signals that tell me in investments what height and a few things might tell me if I was a basketball coach. In the end, what I'm going to buy is the business where I feel extremely certain about the competitive advantage, extremely certain about the integrity and ability of the management. The most important thing to learn is how to value a business.
Is it
It's
okay?
also the toughest to explain.
Yep.
You know,
Short and sweet.
Oh, I can stop it?
Narrow it down.
Yeah,
So
you can stop it.
I'm a basketball.
Okay.
Great, thank you.
Basketball.
Oh, there's a bit of an echo, but
I
thank you.
just stopped sharing.
Yeah, no
Thank
problem.
you.
So while Susan is widening the screen again, the point of that basically, right? And this is again from, you know, arguably one of the best investors, you know, of all time, right? So, you know, he doesn't have a perfect example. There is no perfect way to do this, right? So I don't know, you know, who's on the call here and who's going to be watching this, but there just you know, a lot of what we get taught is this is how to do it, right? And the reality is nobody has a crystal ball, you know, especially trying to identify the next emerging market. You look for signals, just like Warren said, right? You're going to look at those signals to narrow down and go, okay, great. Do we have a pipeline that we start here and we narrow it down to here, right? And then you identify the market. I think from a just a couple, well, I'll get into the details in a second. I'm gonna go on the assumption here, and this may be a very experienced group. I'm going to go on the assumption that there are people that are working to get into the industry. Maybe you own a few properties already. Maybe you don't. I will tell you just a bit about kind of my experience between my partners and I. We currently have over 1,800 units together. We look for, you know, multifamily apartment complexes in the 50 to 250 unit range for acquisition. We're looking for value add opportunities in B and C areas primarily. So that's kind of our window of what we look for and a bit of our experience. So we're used to coming into areas and, you know, that may potentially be on the fringe, but are in what we call the path of progress, right? So you know, it's easier to do those in cities where you really know the area, but really if you're getting started, you know, and coming into this, how do you really identify even a state that you want to be in? How do you kind of narrow the funnel down right from there? So we'll get into that. And so if it's okay, maybe.
Yeah, I was about to, yes. If you could just assume nobody here know anything about
Sure.
real estate, that would be great. And then explain to them what is multifamily. And today we're talking mostly about the market research, but also due diligence, like as an investor, what they need to do, you know, what is expected in a due diligence in order for them to know that their money go in the right place. And then, you know, because this is purely educational. So yeah.
Sure. Yeah, no, I think, you know, one of the things in that video that Warren talks about is how he identifies a business, right? And the clear thing with, so there's a difference between residential real estate and multifamily real estate, right? And while it's both got real estate in the name, there are very different models. So we can talk a bit about that, and I'll jump back and forth between the diligence side and the emerging market side, because there's a lot of crossover, and then we can do some specific specific metrics on what investors, how to diligence a deal and how to look for returns and et cetera. But one of the things that come from the video is that really Warren's looking for the business industry, right, that he wants to be in, right? And then he's looking at the management team, right, and going, hey, do I trust the management team to really kind of get it done? And is this an emerging industry, right? So if we translate that into real estate, the industry that he's using in business is really the market for us, right? What market do we want to be in? Really, real estate is determined based on state and kind of locales, and specifically what's happening in the cities around us, and how do we narrow that down, right? And then the team, that from an investor standpoint, part of due diligence is not just about the deal. Excuse me, that's important, but not the only thing to diligence. You also want to diligence the team, the general partnership team. If you're coming in as a limited partner, that's going to be critical, right? Is what is the saying? The road to hell is paved with good intentions, right? We can put together a really, really good business plan, a really good, way to, kind of structure the improvements of the property and things like that. But can we execute, right? Can the general partnership team get done what's necessary? And some of it is not necessarily, are they able to do it, but is the market able to receive it, right? Are they analyzing, are they looking at the marketplace, right? And that's why I say there's kind of a big overlap between identifying a market and the business plan and the diligence and execution strategy that's right for that market. Okay. So what I'll do is I'll talk about these two topics for a little bit, and then I guess Suze, we're going to open up for questions at the end. Is that the best way to do it? So, okay. All right, sweet. All right. So I'll do a couple things, and let me tell you. So let me go back to the difference between residential real estate and multifamily real estate, and then we'll go into maybe why it's a bit loud in the background here, because that plays into what we're doing right now. But so residential real estate is very much, residential is basically single family housing, right? So you're gonna buy a 1 to 4 unit, house, and there's going to be, if you're going to rent it out as an investment, there's going to be one tenant in the property, right? It's got one roof, it's got one door, it's got one front door, one back door, one lawn, that type of thing, right? And that's really the way that those properties are financed is based on the borrower who's taking control of that property, right? So that's a very clear distinction in the difference between residential and multifamily, right? And I'll tell you more about that in a second. Banks look at the borrowers, right? Less than the property. But from an investor standpoint, if I'm going to take over, a single family residence, right? I want to know that the property next door is doing well. I want to know what the tenant is. If there's a tenant already in there, I want to know what the tenant base, in the area is. If there's not, if there's not a tenant in the property already, because really what I'm buying is I'm buying the neighbor's value and the tenant, right? Is the tenant going to pay me rent? And is the property going to be comparable to other properties in the area? Is there a way that, that the what's happening can be increased, right? Now, so really what I'm buying again is a tenant, and I have to qualify as a borrower, right, for that loan. Those are kind of the two key distinctions on residential. And then when we move into multifamily, which multifamily is really technically anything above 4 units. So 5 units and above, right? 5 units to, thousands of units, right? Buildings can be thousands of units big. Again, we focus typically on 50 to 250 units. So really what we're buying, like Warren said, is a business, right? We're buying the business of what's happening with this asset. We are buying real estate, but we are buying a business. How is the business being run? Is it profitable? Is it not profitable? Right? What are some of the challenges that the business is currently going through, and can we fix some of those challenges? A lot of times, some of the greatest opportunities that we've seen and that you guys will all see are mom and pop ownership that is owned the building for a while, and they know every tenant's name, they know every tenant scenario, they know what's going on, and they have a very caring and appropriately concern for each tenant, right? The challenge with a lot of mom and pop ownerships is they're just not very aggressive, right? So we a lot of times will come in and bring in professional management and take over a mom and pop ownership property and improve the value by improve amenities. Some of the deferred maintenance that may be happening, on the property will take care of a lot of that stuff that the mom and pop ownership just kind of didn't pay attention to, right? And for that, we expect a higher value on the property, which is a direct correlation between higher rents, right? So we'll increase the rents, but tenants a lot of times are very thankful to come in and have more of a structured opportunity and willing to pay a little bit more for that value too. So that's primarily the difference between residential and multifamily right there. So we can come back to any questions around that towards the end too. But to jump into the market analysis a bit, one of the things that is necessary to do is to know the market very well, right? A lot of times, and I see people that are coming into the space, both on the residential and the multifamily side, and they go, oh, I hear about these very sexy, very public, things that I've read in the paper and all that stuff's good to know, but it doesn't mean that that's a market. That doesn't necessarily mean that that's a market that you should be in, right? There's a lot of, storytelling, I'll say, in public newspapers, right? When it comes to real estate market and things like that, and it's our job. And this is part of the diligence process. It's our job to verify if those things are BS or not. As an investor, right? I'm a limited partner in some deals, and I'm a GP in most of our deals, right? But I want to know is what is being said. Is it true or not? Right? And again, nobody has a crystal ball. Warren doesn't have a crystal ball. Some of the best and most wealthiest investors in the world don't have a crystal ball. So we don't know what's going to happen. But there are signals that are consistent that we can look at that go, oh, these things happened over here, and this is what the result was. Now, the next market is showing these signs that if those signals are strong and real and true, that should equate to a return and an execution of what happened in another area. Right now, it's our job to take all of these pieces of data and information and put them all together and go, great, is that real or is that not? Is it a possibility? Is it not? What's the probabilities of this happening versus not? Right? And there's some things that we'll just never be able to control in diligence, right? And one of those is regulation, right? We can anticipate regulatory things, right? But we all know the government does some interesting things at times, right? So there are regulations that can come out of nowhere, right? That could benefit or injure, right? The investment, and that's where it's really important to know that the general partnership team that is managing the properties has experience of dealing with that, because like you said, you're trying to as an investor, you're trying to maximize profitability and minimize risk, right? That is the matrix that is working through there. So I'm here at this coffee shop here, which is a great place called Parish in a little town called Vicksburg, Mississippi. And the reason why I'm here is that we own 80 units here already, and we are looking at a few hundred more units here. I can't dig into more than that, unfortunately, just because it's early on in the process. But we will be putting together a lot of the information around that soon. But even though I know the area and we've owned the original asset here for a couple of years now, it's my job to come out and really get a feel and an understanding of what is happening and a finger on the pulse. Now, Vicksburg, Mississippi is a small town, right? So this is not Dallas, this is not Miami, this is not San Francisco, right? And it's actually easier to see and identify the paths of progress here in smaller towns than it is in some of these larger areas, right? So the way to identify an emerging market right? Or a large market is a lot of times people start by states, right? And they look at what state am I interested in? I think that's a great way to do it and a good starting place. I will tell everybody here up front that my opinion is that you should all be looking in your backyard first. You should understand what's going on, even if your backyard is San Francisco or Los Angeles or New York, where numbers just don't make sense. And if you're not an institutional player, you're probably not going to be too involved in those markets, especially early on, right? But if that is the case, you need to know your backyard, number one, right? You need to understand it. You'll get a good feel for what's happening, who the players are in the area, where the path of progress is, where the kind of next step is for a lot of expansion, things of that nature, right? So so do that first, and then find another market, another primary market that you're looking at. Now, sometimes we get dragged in different areas, right? And we get pulled in different directions, and there's a lot of opportunities or shiny things going in different ways, but it's a very difficult way to be an expert in a market, right? And it means saying no to other markets, right? Is a lot of times what being an expert in a couple markets means, right? So I'm here in Vicksburg, Mississippi. Like I said, great coffee shop called The Parish. This place is opened in March. It's a downtown strip. There's about 50,000 people in the MSA here in Vicksburg. MSA stands for Metropolitan Statistical Area, right? So there's the county, then there's a kind of a multitude of counties, right? And the combination of counties is what the metro is defined as, right? So MSA is a good word, a good acronym to know, and you'll be dealing with MSAs a lot. So the MSA here is about 50,000 people, which is not huge, but the beauty is there's such a expansion here, and there's really kind of some key drivers that are happening. One is that there's an Army Corps of Engineers that is based here, and they're based here because Vicksburg is one of the only places, definitely in Mississippi, and I think in the nation, where there are 3 large national thoroughfares that intersect. There's a national highway that goes all the way up from Canada to Mexico that comes through Vicksburg. There's a national railway that comes through here. And then there's also the Mississippi River. So there's a waterway, a large waterway that's happening here too. So it's a very interesting thing that's going on here. And I'm giving you this example so that you can see and identify this happening in other areas. If you're interested in Vicksburg, excuse me, we can definitely talk more about it, but this is just one of the examples of ways that things happen, right? And there's kind of a key flow of emerging markets, right, that happens. And once you identify a state, you narrow that down to a region, you narrow that down to an MSA, you narrow that down to cities, right, that you know very well, then you narrow those down into zip codes, right, that you start to understand very well, right, and you just kind of taking this big broad funnel of the United States, assuming you're looking at the United States and not internationally, and you just start going like this, right, and that's it. And it's not, you're looking for signals along the way, and you're gonna throw out a lot of different markets that you're just like, wow, that's very interesting or very popular, but not for me, and that's totally okay. Right. I think a lot of times new acquisitions people and new investors are going, ooh, I want to be in this. Ooh, I saw that in the paper. Ooh, I saw that on TV. Ooh, I saw this thing that's going on there. And the problem is, we suffer from paralysis analysis at times, right? Like we paralysis by analysis, right? We try and analyze everything to death, and we go, great. What I look for now is big levers. Right. So I don't need to know all the little stuff anymore. Right. When I first started, I was like, oh, we got to know, got to know every little thing that's happening. And, is Fred pissed off at John over there across the street? And it's not important. What is important are the primary drivers that make big shifts in marketplaces. Some of those are technology, right, which is a huge driver in a lot of different places, especially, changing demographics, especially job growth. And that's one of the things that is happening here in Vicksburg, Mississippi, which is a very interesting thing because it is not notoriously been for that. A lot of times it's refineries and things like that that are happening. And one of the things that I'll mention here too, just as far as market identification, is I live actually in New Orleans now, New Orleans, Louisiana. I moved out there about a year ago. We closed on a 68 unit project in December and started working on that about 6 months before. And I had never been exposed to the New Orleans market before working on this project. From California and Northern California, lived in LA, lived in San Diego. And one of the things that I recognized in that working on that project was that all of the signals that I like to see for new markets and emerging markets and fundamentals were there and present in New Orleans. Now, and I see a lot of those same things here in Vicksburg, Mississippi, right? The very interesting thing is that most people currently are looking at states and state numbers and job growth numbers and population growth numbers and things like that for the states of Louisiana and Mississippi. And the reality is they're horrible from a state standpoint. Job growth is negative, population growth is negative. There's a lot of things that are just really not attractive from a state specific numbers result of those two states, right? So most people write it off, and a lot of our investors say, I just don't invest in Mississippi, or I just don't invest in Louisiana, and it's totally okay, and that's fine. The interesting thing is, though, even inside of these states that are showing macro, poor numbers, there are pockets of things that are happening in there that are very, very exciting, very fun, and sometimes is really where the gems are. I'll just say that, right? Now, I'm not saying this is all the time, and sometimes we see things that are actually not there. One of the things I'll say here too that's important to note is I and our team are constantly asking ourselves, am I wrong? We all have biases. We all have things that we bring to the table, ways we grew up, investments that we got into and, that worked and didn't work and all of these things. And we bring all of that to the table, which is totally fine and okay. The problem becomes when we're not recognizing our own biases, right? So constantly asking yourself, am I wrong? Is one of the best things that you can do as an investor, as an acquisitions person, and I think kind of in life too, just generally. But that's something that I and our team, right, like I said, is constantly asking: am I wrong about this area? Am I wrong about this property? Am I wrong about the growth? Am I wrong about am I wrong about my negative biases too? Am I wrong about I wouldn't have come into these states if I hadn't asked myself those questions, because I said, well, the states have poor numbers, but am I wrong to not look at them, right? And the answer was I was, at the time I was, right? And this is, we're talking a couple of years now, and so the thing that I did though that I recognize is that Louisiana is unique enough that if you are not deep in that market, you, based on their laws, based on their history, based on some of the growth patterns and some of the regulatory restrictions of that nature, things of that nature, if you're not in that market or have a real finger on the pulse there, you can make poor decisions, right? And that applies to any market across the state, right? As you're looking for this, we look for emerging markets, right? We look for the next market, right? A lot of times, again, sometimes they're not sexy, right? Warren Buffett doesn't invest in sexy companies, right? And I'm using Warren a lot because, and obviously, I like that video a lot because he references 7-footers and basketball, which is a lot of fun for me. And I think, for our investors too. But he has his own way that he invests, right? Doesn't mean that it's right for everybody, right? It just means that's what's worked for him, and he's focused on that, right? And he's grown that, and he's growing for value, right? That's his, that's his market, right? He doesn't, if Warren Buffett was a multifamily acquisitions person, he probably wouldn't be doing it in San Francisco, right? Because a lot of times the real estate there is not based on the value, right? It's not based on the current rents. It's based on what some people call the greater fool theory, right? Which is, oh, I know this is going to go up, and I'm from California, and I love California, and I've owned multiple properties in California. But the greater fool theory says that, well, even if the value is not there, if the demand is high enough, somebody else will take this hot potato from me, right? But in the 2008 crash, that was proven, a lot of times incorrect, and sometimes secondary and tertiary markets. So anyways, that's something to always keep track of from an acquisition side, identifying a market and a due diligence side, right? Is there real value here? Is this value that I see and that I'm identifying? Is it real? Is it true? Am I wrong? Right? And you'll answer a lot of questions, about the project, about the area, in that, right? So some of the things to just kind of, take note of as you identify market. One is job growth, right? You want to make sure that job growth in a area that you're looking at is at least 1% increase year over year, right? Jobs drive markets, right? Markets could have, you could be selling gold at $1 an ounce in a market, and if there's no nobody knows about it, right? It doesn't matter, right? And people know about areas because of job growth, because companies come into it, because there's a specific area that they're focusing on. I'll tell you two things regarding job growth that are very interesting, and that both are happening in Vicksburg, Mississippi here, as well as New Orleans. And it's very exciting to me because there are these technology and innovation centers that are popping up in some of these smaller areas, and some of the areas that are specifically known for oil and refining and manufacturing and things like that are great industries and bring a lot of people to them and a lot of stability to markets and areas, but they're also somewhat outdated, right? So a lot of these companies are now looking at going, how can we integrate technology into these arenas, right? For example, I had a meeting with a technology and innovation center called The Beach in New Orleans recently, and they have 360,000 square feet of office space. They used to be run by the Department of Defense, right? You want to talk about governmental control and slow moving things, right? Which is very different than what technology brings, right? Technology brings fast moving, typically younger audiences, and things of that nature. And I'll stop here just for a second, because there is a piece when I say younger audiences, I want to be clear that there is a pattern of what an emerging market looks like, that it happens over and over and over again. And there's some generalities to this pattern. One of them is oftentimes emerging markets have very low income populations, right? Then what happens is there's a primary mover, a primary driver that changes, right? There's a new technology of some sort, right? That's a new company, it's a new industry, it's a new marijuana is a good recreational marijuana is a good example of a new industry coming into areas that when I was doing single family stuff, we had 17 people in the office and we're analyzing markets and doing things like that. And one of the things we realized, we were spending a lot of money on research. And one of the things we realized is that Home Depot was already doing this research, right? They were spending millions and millions and millions of dollars on research to identify new markets. So all we did was go, okay, let's stop spending so much money on research and just follow the Home Depots, right? And it happened over and over and over again that the Home Depot was early in an area, and we go, why here? And then we start looking at things and then finding out that they knew what was going on ahead of time, right? And then lo and behold, 2, 3 years, 4 years later, those areas were now, very popular for whatever reason. The Home Depot's triggers were there. But they were finding those levers, right? They were finding these new technologies, these new industries that came in, and the legalization of recreational marijuana has been a very big driver in a lot of locations, and that's run by the state. But those things are something, if you just followed that kind of pattern and what the new markets are that are legalizing recreational marijuana, however you feel about it, societally and things like that, that's like following the Home Depots, right? So definitely something that is a powerful way to kind of go, okay, let's ride on the coattails of the big folks, right? And we don't want to, I mean, we have a couple thousand units, right? And between our partners and I, and we're not big enough to move markets, right? And it's clear that there's none of that, that we don't have any control over that. We have control over individual properties and the taking care of our tenants, right? And making sure they're safe and they enjoy being in our places, but we cannot move a market. But these big players can move markets, right? They can come in and they can change the way things go, right? For the areas, for the growth pattern, for job growth, et cetera. So going back to what I was going to tell you guys before about the patterns that happen is, starts off typically it's low income areas, sometimes poor infrastructure that's going on in those areas, and then there will be a trigger point, right? Whatever that trigger point is again, new technology, a new industry, a new company, a new large company that comes into the space. Amazon is a good example of a trigger point, right? They bring these distribution centers in. We have a few properties in Baton Rouge that are close to, we knew that a new Amazon distribution center was coming into, and one of them is opening in December. That's very exciting. And we bought a bunch of property around this new Amazon distribution center. It's 860,000 square feet, right?
Where is that Amazon? Where is that? Is that in Pittsburgh too?
No, it's in Baton Rouge. Yeah, Baton Rouge, Louisiana. Okay. Yeah. But again, they're doing a lot of expansion, in different areas across the nation, right? So I don't want to tell you guys what markets to go into. I'm just giving you these examples of how I've identified our markets currently, right? And why I believe them. And so you can hopefully get a feel for how I look at things and how our team kind of analyzes those details to identify a market, right? So the Amazon distribution center again is one of the drivers of change, right? If there's a new Riverwalk coming in, right? San Antonio is a good example of a Riverwalk coming in, and a city and a county putting a lot of money into kind of revamping that area, right? And bringing more people to San Antonio. Now San Antonio is a very popular place, right? But it was a very rough area for a long time for a lot of folks too, right? And there's some nice stuff and there's some rough stuff always in different markets. But Austin, Texas, right, is benefiting from technology, right? A technology movement. Elon Musk brings Tesla in there, blah blah blah, right? You see this pattern happening. What happens is, with the demographics to pay attention to, is a lot of times again low income, infrastructure problems, and then it moves to what I call hipsters coming in. Right. And it's typically a younger audience, right? And they're everybody's, I don't have any tattoos. I'm one of the only probably basketball players that never got a tattoo. But a lot of times it's my sister, both of my sisters I consider hipsters, right? Even though they're probably at the upper echelon, but they're tattoos everywhere, really, really smart. You're typically a younger audience, right? And they start moving into these places. And that's the beginning of the change. That's one of the things that I just look at, and I'll drive an area and I go, do I feel safe here? Do I like it? Do I not like it? A lot of different things that I look at. But what I'm really looking for is like, are there any hipsters moving in, right? And some of this is, again generalizations, right? But I'm looking at the cars that are there, right? And just going, okay, do I see more Subarus here, right? Do I see more of these things that typically hipsters are cruising around in, right? And if I see those are good signals, right? Like there's a good things going, okay, there's more to look at here. And if I don't, I go, okay, is it possible that it's coming? Or are we just way too early? Right. And you cannot time a market, right? Just so we don't have that power, right? The markets are going to do what the markets are going to do. We cannot time them, but we can be in the paths of progress, right? And it's okay to be on the fringe of these paths when you have clear signals and clear identifiers and the fundamentals are moving, in the directions that you think, right? So, so that happens. The hipsters move in, right? And then what will happen is they'll be there for a while, and then families will move in, right? And kind of the hipsters kind of get pushed out because prices continue to rise, right? And a lot of times younger people, either don't want to be in that environment or they want to be at the next, hip, trendy, kind of cool spot, right? So that's kind of the cycle that happens, over and over in a lot of markets. And if you start looking at, just a map of the country, you'll see some of these things happening. I'll tell you a funny story. I did some analysis a couple years ago. I say a couple years, probably 5 years ago now. And really deep dives, trying to identify the next markets, things of that nature. And the two areas that I identified based on the matrices that we put together was New Haven, Connecticut, and Wichita, Kansas. Both have seen incredible growth over the last few years. I did not get into either market. I kind of trickled, and I'm like, Wichita and New Haven, Connecticut, like, I don't know if I want to do that. Can you guys hear me okay? Okay. So I was saying, I don't know if I want to do that. And I didn't, right? And, from a return standpoint, it's like, oh, you did a lot of work for nothing, because those markets continue to grow now. But the big bump that they've seen over the last few years, and these are not sexy markets, right? These are what I call, when I talk with our investors about different projects that are not in sexy markets, I equate them to the toilet paper industry, right? I say, hey, is the toilet paper industry sexy? No, it's not. Does everybody use toilet paper? Is it a product that everybody likes? Is it a multi-billion-dollar industry? Absolutely. Right? Is there a lot of people that have gotten very wealthy off of the toilet paper industry? Absolutely. Right. And that's what some of these markets are. Now, New Orleans is got a little bit more of a sex appeal to it, right? So it's got that, but sometimes that can work against you too, right? So for some of the popular areas. So those are kind of the things that that I'm looking for in different marketplaces. And one of the clear things to do from a model standpoint is also, how about once you identify a marketplace that you want to get into, understand where it is in its evolution, right? And you want, there's different stages of markets, right? Of emerging markets, right? Sometimes a market has already emerged and there's signals that are showing it's declining, right? And some of that is macro, increasing interest rates, increasing insurance rates, decreasing job growth, right? Some of those are macro things, but some of it is very micro and very location specific, right? So you want to know where things are at in that progress, right? In that process. I think that's it. Oh, one of the things that I was going to say too there is it's very important. And I tell everybody that I talk with that's new in the space, it's very important to have a goal, right? How many, if you're looking at the multifamily space, how many units do you want to acquire, right? One of the clear things to understand in multifamily as well is this is very much a team sport, right? There is not anybody that I know that just acquires, 200, 300, 400 units by themselves. There's a lot of work. It's not fun to do by yourself anyways, if you could. And it's very difficult to do, right? So we have a project that we have 33 people in, right? Between our general partnership and our investor group, right? And it's great. We get to keep in communication with everybody. The general partnership team is always talking. It's very much a team sport. So understand, if you're trying to do this alone, and Suze is doing a great thing here by bringing everybody together and I would look to your right and look to your left of everybody who's on this call and everybody in the network that Suze is creating and ping Suze and chat, right? This is what it's all about, right? So, maybe we'll get to work together, Suze and team, et cetera, at some point too, right? So that's it's very much a team sport. Just understand that this is not something that to be done individually. It's great when you know what your strengths are. One of mine is identifying markets, right? And doing due diligence and kind of looking at things going, is this real? Is this not real? What are the risk reward ratios involved here, right? I'm weak in other areas, right? But a lot of our team is strong in those areas, right? So I stay out of that and they say, Seth, it's not you. Okay, great. You got it. Awesome. Right. And it's great to have a team that, that you can work with like that. And you'll need a team of appraisers. That's one of the clear things about identifying a market and going deep into that market is you'll get to know who the appraisers are in the area. You'll get to know who the good ones and who the bad ones are. You'll get to know who the insurance brokers are in the area. You'll get to know, who the brokers are, in that area. And, you develop relationships. And a lot of times, a lot of properties that trade, they don't actually ever make the market, right? Because people have these networks, that are there that they're going, hey, I'm so-and-so's thinking about putting their portfolio on the, up and, it's 600 units. And we have a few deals that we're working on right now that are like that. So, that's a lot of times finding off market deals is how that works. So, anyways, I've talked a lot, and I'll take a pause and see how you guys are feeling. And Suze, if you want to jump in, feel free for sure.
Yes, thank you so much. I was about to call on you a little bit. There's somebody asking in the chat. I have two questions, but I'm gonna let you answer that question first. Somebody say if they want to invest, how much money can they invest?
Yeah, so that depends on every general partnership group, right? I will say that off the top. What we do is, if you're a new investor with us, it's a $50,000 minimum for the projects that we're in. If you're a repeat investor, it's $100,000 minimum, right? So that's our structure. That doesn't mean it's right or wrong. Some people are higher, some people are lower. That's just the way that we do things now. Because I've been in New Orleans a while, now a little over a year, and I know the market very well. I've also identified some smaller opportunities that selfishly we can come into areas, buy single families, smaller multifamilies, renovate them, and then put them back on the market. Our typical syndications for our larger projects are 5 to 7 years. And so investors' money and our money is locked up for that time period, right? We don't do any dispersions of capital typically until we hit our portfolio numbers on the project. In a joint venture, a lot of times those things turn much faster, right? So investors can come in and come out, and the initial investment amounts are typically smaller on those, but it's really a determinant of how many people do you want to have in the deal, right? And there's a lot of creative technology and things like that are happening now where Fundrise is a great example of a company that's doing great stuff in the real estate tech space, that you can get in with $1,000 and be a part of a big project with them, right? It's not something that we do because if we're raising $7 million at $1,000 per, right, we need to raise we have to have 1,000 people, 700 people in it, like 7,000 people in it, to be able to get there. So it's not a model that works for us, but it does for Fundrise.
Yes, but though $50,000, if people do not have that money, can they put money together as a family? And then that's something possible?
Yeah, no, it's absolutely possible. And we have some people that, they say, hi, I got 25 and my friend's got 25 or whatever. What we would ask, and what we do ask in our syndications, is that they create an LLC and come in as the LLC, right? Then we have one point of contact, one communication channel, and then they can work, you know, through the joint venture of their own LLC for their own distributions. It becomes kind of logistically challenging, you know, when you have a lot of people in it. So it's something, that's why we have a lot of those, you know, a lot of those restrictions to come in.
So usually for your investing firm, 7 Foot Finance, so do you guys pay quarterly? Do you guys pay monthly, the dividends? Because I know some company pay quarterly because it's a lot of work doing it monthly. So how do you guys do that?
Yeah, we do most of our projects quarterly. We have some projects. Oh, I keep hearing something in my earbuds. Can you guys hear me still?
No, we good. I think somebody just got out. That's
Oh,
fine.
gotcha. Okay, gotcha. So we do quarterly distributions in all of our syndications currently. We have some joint ventures where they're strictly capital plays and we don't do any distributions. We raise the capital, do a joint venture. They know that, you know, we're going to put these properties back on the market and it's going to be a capital return, plus all of the distributions are going to happen at the end of the sale, right? So, but on our syndications, we do quarterly distributions, yeah.
So do you guys pay like a preferred return or annualized return? How does that work?
Yeah, typically we do a pref of 7% at minimum. And you know, we've done some stuff up to 9. It depends on the project, right? So each project you want to make sure that, you know, if you're coming in as an investor on, you want to look at the executive summary and the business plan, right? And understand the PPM very, very well, which is the private placement memorandum, right? So of what the specific property plan is going to be, right? And that changes depending on, you know, who you're investing with. Some people invest in only A properties, right? And A assets in A areas, and you know, that's their model, right? And they're not doing a lot of value add. They're just going, hey, these are already in growth areas, and kind of the market is going to do what the market's going to do, and we're just going to ride that, right? We're not forcing any value adds into those day markets, right? That's not our model, right? We come in again in B and C models and B and C areas, right? We'll come in. We like to take over properties with problems and come in and work through those problems and do a forced value add opportunity, which is great for us and for our investors.
Yeah, B and C property, it's a category that you can put your property in, like he's saying A level. So those are like new build, nothing less than 10 years old. And then of course you go to B, C, and D, and so our neighborhoods, you have B, C, and D. Of course, D is like where you have the drug dealers. That's how they call it. So just so you guys have a perspective of what he's talking about. So Seth, as far as the money, can people also use their 401k, IRA, and that kind of stuff?
Absolutely, yeah. That's one of the great things about you know, about real estate is that it's there's a way to invest IRA money. There's a way to invest 401k money. One of the things that I will also add is on all of our syndicated projects, we do what's called a cost segregation study. And that study basically, I can't quote any hard numbers. I can tell you kind of what we've done in the past, but we just did a project that for every dollar that was invested, 40 cents of that dollar was deductible against other gains in other areas. And there's other ways to use that, but if you guys aren't familiar with cost segregation studies, we have a webinar that we've done and recorded, and Suze, I can get that to you, and you can disperse it amongst your group if you want to. Just reach out to Suze and she'll get it to you. You know, for sure. That talks a lot about the specific ways to do that, and we have people that, you know, that we work with in the past that our investors have used and liked, and make those recommendations if anybody's interested in that.
Great. Does anybody have any other questions? Because I have 2 questions. I don't want to be the one asking question only. I was going to the chat and reading. So does anybody else want to ask the question directly? It's already 3 o'clock. No. So I guess those are my personal questions. So it's Pittsburgh, Mississippi. Is that a tertiary market?
So it's Vicksburg with a V, VICKSBURG. Yep. Yeah, if you're looking for Pittsburgh, Mississippi, I'm not sure you're going to find it, but Vicksburg is definitely there. Yeah, it's a tertiary market. One of the things that I didn't mention that I probably should is the Milken report. If you're not familiar with the Milken report, get familiar with it. It's one of the best reports to identify kind of, they're really a lagging indicator report, right? So it's what's happened last year and how those markets shape up. But one of the things that I saw in the Milken report in 2021 for New Orleans was, and I can show it to you. I pulled it up if we got a minute, Susan, I can show it. Do we have some time or?
Oh, it's 3:01. I mean, I guess at
Okay.
this point it's on you because you are the speaker.
I'm okay. I've done my diligence here,
Yeah.
and I have a few more minutes, and I just have to get on the road to get back home. But I can show this real quick. Let me share the screen real fast and show you guys. So this is the Milken report, and you know, I can put this this link in the chat if that's helpful too.
American Institute.
Yeah, they do a very good job of culminating a lot of data, right? The other great resource is Redfin has a data center, right? That if you're not familiar with Redfin, they're a real estate tech company, and a lot of their focus is on the residential side, but from a demographics and kind of a historical, you know, they're very kind of cutting edge and current with migration patterns, things of that nature, right? Which are important for us to, you know, But what I will do here is I'll show you this thing here. So Milken report, you know, talks about different different locations. What are kind of the rising, what are the ones that have risen? What are the markets that have risen already? So be clear that this is not a leading indicator report, right? This is a lagging indicator report, right? If you're reading it on the Milken report, it's already happened. Okay, it doesn't mean that it's not going to continue to happen. It just means the moves that are already being made have already that are being reported here have already happened, that are being reported against, right? Okay, so that's a very clear indication and a clear thing to understand. So there's tier one, there's large cities and small cities is how they break it down, and then they do different tiers. And there's 5 tiers of the large markets, and New Orleans is a 5th tier large market. Okay. But one of the things that was an initial indicator when we started working on the first project that I saw for New Orleans is, let's see, is it right here? So you see New Orleans here, right? And I'll go through this, but these 2 numbers are the ones that I want you guys to focus on here, and I'll show you what they are, right? So this is 185 and 98, okay? These are where these cities place amongst other cities at the time based on their growth. So you want to see improvements in those areas over time, right? This categorization is the one that I look at specifically, and it's high tech GDP growth, right? So it's high tech GDP, which is the amount of money that was made in the tech industry in this area from 2014 to 2019, and how it ranked, how New Orleans ranked between that time amongst other cities. It was 185th, okay, which is not amazing. This is the most recent number with 2018 to 2019, right? So this is a 5-year span, and this is a 2-year span, right? But these are obviously much more recent, and this number is ranked 98, right? So that's a big move from 185th to 98. And again, this is a 2001 report, right? So this is a lagging indicator, right? This is something that has already happened and already going, right? So, but those types of things, you find those, and those are fundamental shifts in markets that are happening currently, right? And that's just what I look at it. There's a lot of topics here, you know, on these that are great, and other people, you know, don't focus on tech like I focus on tech. But I've seen it happen continuously, time and time again, especially in, you know, some of these smaller, you know, like I said, this is a tier 5 city, right? So anyways, that in Jackson, Mississippi is on here, et cetera, right? But you can see Jackson, Mississippi over the same time period 150th to 81st, right? And again, this is 2001, and Jackson, Mississippi is dealing with some flooding right now. It's national news, but there's a technology growth in Jackson, Mississippi, right? Vicksburg, Mississippi is not even considered a large city. I don't even think it's considered a small city on here, right? It's such a microcosm, right? So different reasons why people get into different areas. But anyways, I hope that's helpful to see.
Great. Yeah, it was really good. So I have one last question for you.
Sure.
What will be the one reason you will or will not go into a market?
Yield. If I can't get our investors yield, then I won't be in that market. It's very difficult to find that yield in California, in a lot of, at least the primary markets in California. It's very difficult to find that in New York. And if I can't, with a high level of confidence, we're gonna hit our numbers, get our investors their yield, not in.
All right. Great. Thank you so much. Any other questions, guys? Do you guys have any question? And I also have I put some stuff in the chat. What's the next topic you guys want to discuss? Also on the 24th, we have our next speaker. He has $2,500. He's gonna be pouring into us. He's gonna be coming here, giving us like his background, how he started and that kind of stuff. So it's gonna be really trying to give you a case scenario. I mean, he was a police officer and that kind of stuff. He was also in the Army, and he's gonna be discussing how he get there and how he started. So I hope you guys are ready for that. And then we're also having a CPA that's gonna be talking how you can use your 401k and IRA, most likely self-directed IRA. We have a lawyer gonna be talking about that coming up. So we have a whole bunch of lined up speakers for you guys coming along, but I also would like you guys to give me an idea what you guys would like to hear from. Maybe not this year. For this year, we already kind of like have most of those topics lined up, but for the next year, because the reason why we started now, and of course, I'm going to be coming with the CPA and the lawyer talking about IRA and then taxes as well, like how you can use your taxes. Let's say you have a lump sum of money, somebody, you inherited something, so how you can use that. And let's say you have residential properties or you have solar property, how you can use that and pay less taxes and that kind of stuff. So, and then he did discuss about cost segregation and all those things going to be discussed. Right. So if you guys have those information, again, these meetings are purely educational. And the only reason I started it, I wish I knew all those information 10 years ago. So, and of course, we didn't know then, but now we know. And the fact that now I know and I'm learning every day, I want everybody else to know. I want people to that is in my situation I was then, to know those information and know what they can do their money. And then like he said, it doesn't have to be, you don't have to be a whole lot amount of money. And if you don't have enough money, so let's say you have 5 members, your family, and you guys can put together $50,000. And usually people put those money in CDs and that kind of stuff. But if you guys can put that money together and start growing it in real estate, or you have a fund, something you want to go for your kids' college, anything. So that is the idea behind those meetings. And if you guys are interested, and also we do 1031 exchange, which was not also discussed. So anything like that, so just reach out and let us know, and we will connect you and we will give you information and we will get you into deals. So that is the only reason. But the only thing though, I need everybody's email so I can send you an accredited form. If you're interested, we'll send you an accredited form, and that way you'll fill it out. And then we can start having a conversation with you. Until you fill out that form, we cannot really be telling you much. We can give you the general information, but according to SEC laws, until you fill out that form, we can't really get into the nitty-gritty of stuff with you. So thank you so much for everybody who've been there. Thank you, Seth. It was
You're
a
welcome.
great
Thank you.
presentation, and I'm sure we're gonna learn a lot about this. Oh, by the way, the other report you were talking about, you said the Milken report, and you said if they need more data, you did mention another one. It's not waiting. I wanted to write.
Redfin is the redfin.com, redfin.com, and they have a data center, yeah, for a lot of the migration and patterns that are happening. It's FIN, REDFIN.
Yes.
Yep.
FI. Oh, Redfin.
Yep.
Okay.
FIN. Yep.
All right.
Redfin's probably a good
Yeah,
website
yeah, I heard
for fans of Red too.
Okay.
For sure.
Yeah, but I never use it to pull out data. I knew it was more like residential. I guess that's why I never pull into it. Yeah.
Yeah, no, it's good, and it is mostly residential, but it's good for, like I said, migration patterns. You know, some of the sales information on the residential does impact multifamily, and that's one of the reasons why we're doing some residential improvements in New Orleans, is because, like I said, selfishly, we have you know, a lot more, our goal is to get 800 units in the next few months in New Orleans, and the improvements that happen in the residential areas and the paths of progress will turn those quickly, but that improves the areas that our apartments are in as well. So it is a way to kind of, you know, be a part of the shift that's already happening.
All right. Okay, thank you so much, everyone. I know it's 3:12. We took another 12 minutes out of your life, and we truly appreciate, and I hope you keep on coming to those meetings. Invite your friend, invite as many people as possible. When I send you those links, invite people, because especially people in our community. So people don't know those information. And of course, this is free. People not paying for it, just an hour of their life, but they will learn a great deal. As you can see, you guys learned a lot today. And if you guys continue to come to those meetings, you know better how to move and how to act and how to behave with your money and what to do with it next. Or if you don't have them, well, at least you have the knowledge for now. And when that money comes, you know what to do with it. Thank you so much.
Absolutely. Thanks, Sis. Thanks for having me. Thanks, everybody. Take care.
Thank you, Seth. Bye-bye.
You got it. Bye-bye.